Hi, and welcome to Really Understanding Incoterms 2020, a series of comprehensive masterclasses. I'm Bob Ronai, and this is lesson number 7, the second part of CPT, Carriage Paid To, and CIP, Carriage and Insurance Paid To, Named Place of Destination. But first, the necessary disclaimer. I am not a lawyer. The contents of this course are not legal advice. I was a member of the International Chamber of Commerce's Incoterms 2020 drafting group, which created these rules. Some of the contents in this lesson are direct quotes from the Incoterms 2020 publication number 723E of the ICC. My explanations, my comments, and my opinions are based on my knowledge and my experience of over 5 decades. My intent in creating this comprehensive course on Incoterms 2020 is to ensure that my knowledge and my experience is passed on to you for a better future for you in trade. In this lesson, we'll continue with CPT and CIP. We've already looked at the more complex and contentious articles, especially A2 and B2, delivery and taking delivery, in the previous lesson. In this lesson, we'll look at A10 and B10 notices. Then we'll look at insurance under CIP and finish with the problems that CPT and CIP have with letter of credit transactions. As always, I will explain what the book says first. But then I will examine the issues arising from these articles as we go along. A10. Notices. The seller must notify the buyer that the goods have been delivered in accordance with A2. The seller must give the buyer any notice required to enable the buyer to receive the goods. And B10, the buyer must, whenever it is agreed that the buyer is entitled to determine the time for dispatching the goods and or the point of receiving the goods within the named place of destination, give the seller sufficient notice. The buyer determining the time for dispatch might be relevant for short transit time sea transport and for air and road transport. The point within the place of destination might be relevant for project cargo or ports where there are more than one terminal. These avoid the need to amend the actual contract of sale. But you would expect there would be the obligation also on the buyer to inform the seller where the place of destination is. A5. Insurance. Unless otherwise agreed or customary in the particular trade, the seller must obtain at its own cost cargo insurance complying with the cover provided by Clauses A of the Institute Cargo Clauses LMA IUA or any similar clauses as appropriate to the means of transport used. The insurance shall be contracted with underwriters or an insurance company of good repute and entitle the buyer or any other person having an insurable interest in the goods to claim directly from the insurer. When required by the buyer, the seller must, subject to the buyer providing any necessary information requested by the seller, provide at the buyer's cost any additional cover, if procurable, such as cover complying with the Institute War Clauses and or Institute Strikes Clauses, LMA IUA, or any similar clauses, unless such cover is already included with the cargo insurance described in the preceding paragraph. The insurance shall cover at a minimum the price provided in the contract plus 10% i.e. 110%, and shall be in the currency of the contract. The insurance shall cover the goods from the point of delivery set out in A2 to at least the named place of destination. The seller must provide the buyer with the insurance policy or certificate or any other evidence of insurance cover. Moreover, the seller must provide the buyer, at the buyer's request, risk and cost, with information that the buyer needs to procure any additional insurance. We'll examine some of these. The seller must provide the buyer with the insurance policy or certificate or any other evidence of insurance cover. A policy is usually a standalone insurance for one shipment or for multiple shipments during a stated period. A certificate is usually issued under an existing open or annual policy held by the seller for that one shipment only on the certificate. Most insurance documents will name the seller as the insured or assured and will require endorsement, so whoever has the insurable risk at the time of an event can make a claim. Be careful too about who countersigns the face of the document. If there's provision for that countersignature, it should be the seller. The insurance shall cover at a minimum the price provided in the contract plus 10% and shall be in the currency of the contract. Why the extra 10%? A legal book going back into the 1800s reported a case in which an additional 3.5% was for loss of imaginary profit. But that was a different era and different import processes entirely to now. So I disagree. Loss of imaginary profit is different to loss or damage of goods. And these days, a fixed allowance of 10% is added to the invoice value to include extra costs such as port charges, import clearance, trucking, bank charges, staff unloading costs, which all must be factored into the ultimate claim value. Clauses A of the Institute Cargo Clauses, or any similar clauses as appropriate to the means of transport used. What are these clauses and what do they mean? Well, LMA and IUA is Lloyd's Market Association / International Underwriting Association. They are as close as you can get to the mythical all risks. They cover everything but do have specified exceptions. And they cover general average, which is a whole different topic. There is an equivalent for air cargo, ICC Cargo Clauses Air. Institute War Clauses and Institute Strikes Clauses are separate and additional. B5. The buyer has no obligation to the seller to make a contract of insurance. However, the buyer must provide the seller upon request with any information necessary for the seller to procure any additional insurance requested by the buyer under A5. In summary then, these rules are identical except in just the one aspect, insurance. Many people think that delivery under CPT and CIP is when the carrier delivers the goods at destination. Not so. Delivery occurs when the seller gives the goods to their carrier and the buyer is obliged to receive them or take delivery. What is not mentioned in the rule is where this delivery occurs. We can assume the options are similar to those in FCA, A, loaded on the carrier's vehicle at the seller's premises, or B, not unloaded from the seller's vehicle at the carrier's premises. CPT and CIP and letters of credit. How does an LC function with a CPT or CIP transaction? I'm afraid it doesn't. LCs almost invariably specify a port of loading, a port of discharge, a latest date of shipment, and require presentation of an on-board transport document, etc. These are all after delivery, even though the seller's responsibility is to contract and pay for carriage. So an LC for a CPT or CIP transaction should only require presentation of the seller's invoice and a received for shipment bill of lading. And the seller is the shipper. There is no provision in the SWIFT LC format for latest date of receipt of goods by the carrier. So as a buyer, what do I request my bank to state in the LC for both CPT and CIP? Only field 44A, place of taking in charge, and field 44B, place of final destination. They are not to show 44E, port of loading, or 44F, port of discharge. They are not to show field 44C, latest date of shipment. Require presentation of a forwarder's cargo receipt, dated no later than whatever date, showing place of receipt and place of final destination, instead of an on-board bill of lading, or maybe a received for shipment bill of lading with the same information. As a buyer, what else do I request my bank to state in the LC for CIP? I suggest you require presentation of, quote, one original insurance certificate or policy endorsed in blank under Institute Cargo Clauses A, or if it's air freight, air, Institute War Clauses Cargo, or air cargo, and Institute Strikes Clauses Cargo, or air cargo, for 110% of the invoice CIP value. That's it. There is, in this third decade of the 21st century, no need for showing agent at destination, claims payable in destination country, strikes, riots and civil commotions, transshipment risks, warehouse to warehouse, and all the other nonsense that is long outdated and or incorrect, but banks still keep using them. In our next lesson, well, 3 lessons. Yes, 3. We will look at the DAP rule and the almost identical DDP rule. The more complex and confusing articles, A2 and B2, delivery and taking delivery as always. Then for each rule, we'll look at A6 and B6, delivery and transport document, A9 and B9, allocation of costs, and A10 and B10 notices. We'll look at A7 and B7, export and import clearance, to see the differences between DAP and DDP. As always, I will explain what the book says first, which is where the other trainers and YouTube videos usually stop, but then I will examine in detail the issues arising for these articles as we go along. If you like this lesson, please click on the thumbs up button below. If you'd like to be alerted to each new lesson, please hit the subscribe button and the bell. And please leave any comments you like and questions relevant to this lesson below. Till next lesson.